In Chapter 8, we will be looking at individual income tax computations, which you have already seen, as well as tax credits, which is the bulk of our discussion. So we'll be looking at how you determine a taxpayer's regular tax liability, which is a review, also a special tax called alternative minimum tax, calculated taxpayers' employment and self-employment taxes payable, computed taxpayers' allowable child tax credit, child independent care credit, the American Opportunity Credit, lifetime learning credit, and earned income credit. Now there are other tax credits available. These are your most common. And then the final area we'll be looking at how we compute a taxpayer's underpayment, late filing, and late payment penalties, if applicable. So remember, when it comes to computing federal income tax, we base it on filing status, married filing joint, qualifying widow or widower, married filing separately, head of household, single. Remember, we use progressive tax rates. We either use schedules or tables. Now, the tables are not in your book, but you can find them on the IRS's website. The IRS expects you to use the tax rate tables when your taxable income is less than $100,000. But if your taxable income is above $100,000, you could use the tax rate schedules to compute the tax in Appendix D in the back of your book. And again, it's based on filing status. These tax brackets, or those marginal tax rates, are 10%, 12, 22, 24, 32, 35, and 37. I'm not too worried about marriage tax penalty or benefit. Okay. I wanted to move on. Exceptions. Now remember, if you have special preferenced items, they may be taxed at lower rates, such as long-term capital gains. Generally, your tax rate will be 0, 15, or 20%, depending on your normal tax rate. Dividends. Qualified dividends are also generally taxed at 0, 15, or 20%. Remember, we looked at this back in our investment chapter on when to use whatever rates, but just to refresh your memory. Now, when we compute tax, sometimes there's what's called a kiddie tax. A kiddie tax has come about back in the 1970s, I think it was. The parents were trying to find a way around shifting their income from themselves to their children. So what they would do is put certain items in their children's name, they do it legit, and transfer all of this investment so that the income on those investments were being taxed at their child's tax rate and not their own. Well, the government caught on to this and they created what's called the kiddie tax. And here's how they look at it. If the child is under 18 years old at the end of the year, or the child is 18 years old at the end of the year, but earned income does not exceed half of their support, or the child is over age 18 but under 24 and a full-time student, and the earned income does not exceed half of her support, then the kiddie tax applies to them. So these are listed on page 8-6. So if your child falls into one of these and their net unearned income is more than $2,100, they'll fall into this kiddie tax. And there they are again. It applies to children who are under age 18. The child is 18, but earned income not greater than half a child's support, or the child is over age 18, under 24, full-time student, and their earned income is not greater than half of their support. Assume Courtney's taxable income is $462,400, including $15,000 of qualifying dividends. Oh, I'm sorry. Let's stop there. It looks like our PowerPoint took us right into an example for calculating tax. I want to take a look at kiddie tax example on page 8-7. What happens there? So the kiddie tax base is the child's net unearned income. So the child's gross unearned income minus $2,100 or the child's taxable income. That's what will be used to compute the kiddie tax. The kiddie tax does not apply unless the child has unearned income greater than $2,100. So, in example on page 8-7, example 8-5, suppose that during 2018, Darren received $5,100 in interest from the IBM bonds and received another $2,200 in interest from a money market that his parents have been contributing to over the years. It's Darren's, but his parents have essentially been putting the money in for him. If Darren is younger than 18 at the end of the year and his net unearned income exceeds $2,100, what is Darren's taxable income and corresponding liability? Well, his gross income would be the $5,100 plus $2,200. His standard deduction allowed is $1,050. So his taxable income is $6,250. His gross unearned income, gross unearned $7,300 minus the $2,100 is $5,200. And it is that net unearned income that is taxed at a kiddie tax rate, which would be the trust and estate tax rate schedule. So that part of his income is taxed under special tax rates, and they're in Appendix D. Let's find that again. They just changed this with the new tax law. It used to be taxed differently. So I'm on D, and on page D-1 it says estates and trusts. So the income above $2,550 to $9,150 is taxed at 24%. So $5,200 minus $2,550 times 24% plus $255. That part of his unearned income is taxed under those rates. His remaining taxable income of $1,050 is taxed at a normal single individual's rate, $105. So his total tax would be $891 plus $105, $996. Now, let's go to this example. Assume Courtney's taxable income is $462,400. Included is $15,000 of qualifying dividends taxed at preferential rates. What would be her tax liability? We're assuming here Courtney is single. Go to Appendix D. Her taxable income is $462,400. $15,000 of it will be taxed at a different rate, so we subtract that. We find the single taxpayer. Taxable income is $447,000, so it's between $200,000 and $500,000. So we'll take the $447,400 minus $200,000 times 35%. Add to that I'm sorry, she must be head of household. Yes, I'm sorry, it's the head of household rates. $44,298. It's the Schedule Z. I missed something there. Sorry about that. So her tax on her normal income is the would be the $130,888. Okay. Now, bear with me one second. Okay. If you go back to Chapter 7, there's special tax rates with regards to preferential tax rates. Head of household 447. Okay. Because her income is above $452,500. Okay. And this is on page 7-10. $452,500. $400. The part of her income, $447,400, that would take her up to $452,500. $5,000 of it will be taxed at the preferential rate of 15%, because income, even we're not just talking about preferential income. We're talking about income plus preferential. Up to $452,400 would be taxed at 15%. the amount above that would cause her to go into the next range above 452,400. So the remaining 10,000 will be taxed at 20%. So she still gets preferential rates on those, on that $15,000. It's just it's not all at one tax rate because she's on that area where you're going from one rate to another. So you got to be careful of that when calculating it. So her total tax would be $133,638. If Courtney had $15,000 of preferentially taxed income, $10,000 of her dividends fall in the 20% bracket, and that's what we were just talking about there. An additional tax that may be imposed because you have net investment income. It's a 3.8% tax. It's actually a Medicare tax that's imposed on the lesser of net investment income, so interest, dividends, annuities, royalties, rents, passive activity income like rents, net gains from disposing of property, or so it's imposed on the lesser of that, or the excess your modified adjusted gross income is above $250,000 for married filing joint, $125,000 for married filing separately, and $200,000 for all others. So it's meant to provide an additional tax to higher income taxpayers. Suppose that during 2018, here's our ldunn. They have the things mixed up a little bit, but this was essentially the example we went over in your book, so I'm not going to go through it again. Okay. Let me see. I apologize for this. To learn more about the net investment tax, it's on bottom of page 8-5, and let's look at the example on 8-6, example 8.4. And then we'll talk about what's in front of us, alternative minimum tax. Courtney's AGI is $187,000, and her investment income consists of $321,000 of income interest, $700 dividends, $5,000 rental income. How much net investment income tax will Courtney owe? Well, zero, because her modified adjusted gross income is less than the $200,000 threshold for the net investment income tax for a taxpayer filing as head of household. And I guess somewhere in the chapter they told us that. Assume instead it's $225,000. How much net investment income tax will Courtney owe, in addition to her regular income tax? Well, her net investment income is $6,021. The $321 plus the $700 plus the $5,000. Her modified adjusted gross income is $225,000. The threshold for married filing, not married, for head of household is $200,000. So you take the lesser of the net investment income or the amount the AGI exceeds the threshold. The lesser is the $6,021. Multiply that by 3.8%. And that additional tax would be included on Courtney's tax return. Speaking of additional taxes, another tax that may be added to a tax return, although it's kind of deceiving, it sounds like it's a minimum tax, like it'll lower your tax. Actually, no. It's saying if this tax is higher, this is the tax you pay. We actually compute for certain taxpayers a parallel system of taxation. It's called the Alternative Minimum Tax, AMT. And the way we compute it is we take the person's taxable income from their 1040. We add back standard deduction. Okay. We add back certain other adjustments. And this gives us what's called the alternative minimum taxable income. And these are very unique items. We're not going to get into all of them in an advanced tax class. You will. But just to get a flavor for them, on page 8-9, the bottom of the page, you see the bullets there. What's important is if you do itemize, now standard deduction, you have to add all of that back, but certain itemized deductions are allowed. Charitable contributions, home mortgage interest expenses, and gambling losses are allowed to be taken as a deduction for AMT. So if you have medical expenses, you may have to add those back. If you have state and local taxes that you deducted normally as an itemized deduction, you'll have to add those back. Okay, so you just keep that in mind. Some other possible types of adjustments are if you have tax exempt interest from special private activity bonds, and that would be noted on the 1099 INT, you would need to add that in. It's normally non-taxable for regular tax purposes, but for alternative minimum tax, it's taxable. There's the real property and personal property taxes that you deducted when you itemized. Add those back. State income or sales tax, add those back. Sometimes certain depreciation may need to be added or subtracted. Okay, so these are just some of the common items that people will use on an to compute their AMT. Once they compute the alternative minimum taxable income, they then are able to subtract an AMT exemption amount, and that's based on filing status. Once you subtract that, you get your base. Depending on your base, you will apply a tax rate, and then you will calculate your tax under alternative minimum tax rules. If that amount is higher than your regular tax that you computed on your 1040, the amount above your regular tax will need to be paid in addition to your regular tax, and that's the alternative minimum tax. So technically, some of these adjustments are referred to as preference items and some are referred to as adjustments. Who cares? We're going to call them all adjustments for simplicity's sake. The items commonly added back again to regular taxable income to compute this AMT income: tax-exempt interest from private activity bonds, state income taxes, and real property taxes that you deducted as an itemized deduction to compute your regular taxable income. The AMT exemption amounts. You are able to deduct, if you're married filing joint, $109,400 from your computation. Married filing jointly, head of household, and single are listed there. Those exemption amounts phase out as your alternative minimum taxable income reaches $1 million for married filing joint, $500,000 for all others, and they phase out 25 cents for each dollar it's above that amount. So once your income reaches those far right amounts, alternative minimum taxable income, that is, you do not get an exemption. It will all be taxed. So again, the AMT is a tax base in an alternative, more inclusive tax base than what regular taxable income is. It's meant to ensure that taxpayers are paying some minimum level of tax, and it's usually going to affect people with large amounts of capital gains. Now, before we go on to employment FICA taxes, let's take a look on page 8-12. Example 8-7. Actually, let's go to 8-10 and start with that there. Courtney's continued. Let's go to Courtney. Courtney continued to work on her AMT computation by determining the other adjustments she needs to make to determine her alternative minimum taxable income. And you remember a couple slides before, and this is also on page 8-9. We start with the regular income tax, taxable income, regular taxable income, 145,070. We would add or subtract any adjustments that may be allowed or not. Now in Courtney's case, she had tax-exempt interest not recognized on private activity bonds, so she has to add that. It's not all tax-exempt interest, it's just special kind. Itemized deduction for taxes. She was able to deduct $10,000. She has to add it back. That's not allowed for computing alternative minimum tax. She had a state income tax refund she needed to add into her income. Well, since they don't allow those items to be subtracted, you don't have to include it in alternative minimum taxable income. So we're going to subtract it. So her alternative minimum taxable income before applying any exemption is $155,150. Now flip to page 812. Now, Courtney is a head of household, so she now gets to subtract her exemption. Since her income is below, her alternative minimum taxable income is $155,150. It's below the $500,000. She could take the full exemption amount of $70,300. So once she subtracts that, her AMT base is now $84,850. Now go to page 8-13. Her AMT base is $84,850. She has dividends taxed at preferential rates of $700. Based on the information on the bottom of page 812 to 813, we will now compute her AMT. Her dividends are still being taxed at 15%. The remaining AMT base is taxed at 26% because the first $191,100 is taxed at 26%. The amount above that, 28%. So the total tentative minimum tax, $21,879 plus the $105, $21,984. Her regular tax is $27,652. That doesn't mean she only has to pay $21,984. No, this alternative minimum tax only kicks in if the tentative minimum tax is above the regular tax liability. Okay, so that was just a nice quick run through on how alternative minimum tax is calculated and what it actually is. It's not a minimum tax, it's really a maximum tax. The next slide deals with FICA taxes, Social Security and Medicare, and this is more of a review. When it comes to an employee, we don't have to worry about this. Our employers automatically withhold 6.2% of our gross pay up to a certain level. In 2018, it's $128,400. So once your gross pay reaches $128,400, you don't have to pay any more Social Security, 6.2%. 1.45% of Medicare tax is also withheld. And in addition, Medicare tax rates on salaries in excess of $200,000, $250,000 married filing jointly is also withheld. The employer also has to pay a 6.2% tax on for Social Security using the employee's wages that were also used to compute that tax, and 1.45% in Medicare tax. So the government gets money from an employee and an employer for both those taxes. Now, what happens with the self-employed person? We've talked about this a little bit. The self-employed person is responsible for both the employee and the employer's share of additional Medicare tax. How do they compute it? They take their net earnings from their Schedule C. The first thing they do is multiply it by 0.9235. It's actually 100% minus 7.65, the normal Medicare Social Security rate. That amount of net earnings is what will be used to compute self-employment tax, or the self-employed individual's Medicare and Social Security tax. If their amount they just computed is below $128,400 for 2018, 15.3% is the tax on that income. If the net earnings computed are less than $400, you don't have to do anything. Okay. What if it's above $128,400? Well, then you only have to compute the 12.4%, 6.2 twice 12.4% for the Social Security on $128,400. You would compute the Medicare portion, or 2.9%, on all of those earnings. Add those two together. How does the $128,400 limit apply when you receive both wages and self-employment earnings? Well, Wages use up the limit first. So what this means is when you're computing your self-employment tax, you're going to say, how much were my gross wages for the year? For the Social Security portion of your self-employment tax, you would then only be taxed on the amount from your gross wages up to $128,400 if you have that much in earnings. All of your earnings from self-employment are subject to Medicare. Assume Courtney received $100,000 of taxable comp from EWD in 2018, and she received $180,000 in self-employment income from her weekend consulting activities. What amount and additional Medicare tax is Courtney required to pay on her $180,000 of business income? Assume that Courtney's employer correctly withheld $6,200 of Social Security tax, $1,450 of Medicare, and $0 of additional Medicare tax. Well, the first thing she would do is compute the amount of Social Security that she would have to be liable for. Of the $128,400, she's already paid $100,000 of gross pay, so the remaining would be $28,400. Of the $180,000, 92.35% of those earnings are what are subject to self-employment tax. So, of the $28,400, she would still have to pay 12.4% on that, or $35.22. The Medicare tax will be based on the $166,230 times 2.9%. Add those two together, that is her net earnings, at the $35.22 and $48.21, that's her total self-employment tax. Since she's already earned, the sum of her comp and net earnings from self-employment is $266,230. And she's above the threshold of $200,000. She would have to pay an additional tax on the amount. Her total compensation and self-employment tax is above $200,000, so $66,230. This is different than that 3.8%. This is an additional Medicare tax on 0.9%. So her overall additional tax, $35.22 plus $48.21 plus the $596, $89.39. That's how self-employment tax works with this additional Medicare tax. You could read through this. This is important for people to, and actually companies, determine who's an employee and who's an independent contractor. Employees usually just pay their share of FICA, where independent contractors are considered self-employed and they're paying not only their share but the employer's share, and they have to worry about special tax forms to use and all that fun stuff like a self-employed person. Okay, so those were some additional taxes and items that would appear on our tax return, kind of special items that pop up. If we qualify for them, we got to do them. Now we're going to talk about tax credits. These are nice things. We like these things because they reduce our tax liability dollar for dollar. There are what we call non-refundable personal tax credits. All that means is that if your tax credit is above your tax liability, you just reduce your tax liability to zero and you don't get any additional amount. A refundable personal credit says, oh, your tax credit is above your tax liability. Well, not only do you bring your tax liability down to zero, but you'll also get a refund for the excess from the government. And then there are special business tax credits, which I just want to make you aware that they're there. We're not going to go through them. We're going to look at the personal tax credits. The first one being the child tax credit that has changed significantly. The child tax credit used to be a tax credit for $1,000 for each qualifying child under the age of 17 at the end of the year. It used to be $1,000. Now it's $2,000. Okay. And it used to phase out at a much lower income rate than it does now. So I could tell you from my own personal experience, I have always phased out of the child tax credit. I've always made too much money. This year, I qualify on my income, 2018. But guess what? My son turned 17 during 2018. So I'm one of those people who just lost out on this credit. I got in the transition. Nice. I still will get a $500 though credit for my son, tax credit, under this area for each qualifying dependent. So a child who's a qualifying child but 17 or older, or a qualifying dependent, okay, you will get $500 per qualifying dependent of a tax credit. Not as much as $2,000 of a tax credit, but better than nothing. Here's the beautiful thing about the phase outs. They're very high. Married filing joint, your AGI is $400,000. Married filing separately, head of household and single, $200,000. Before they were like $80,000 and $120,000 or something like that for married filing joint. So it has substantially changed, and a lot more people will have the ability to take this. Now, the credit does phase out. It phases out $50 for each $1,000 your AGI is above the phase out. So I'm not going to go into child and dependent care credit. That's something different. Let's take a look on the top of page 825 so you could see an example of this. And remember, this is per child. You get $2,000 who's under 17. That's a qualifying child. And it's $500 for a qualifying child who doesn't, who's 17 or over, even if they're a full-time student, doesn't matter, or a qualifying dependent for each case of it. So both Ellen and Duran are Courtney's qualifying children. Courtney may claim $2,000 in child tax credit for Duran because he is under age 17 at the end of the year. Courtney cannot claim the $2,000 child tax credit for Ellen because she's not under age 17. But Courtney may claim the $500 credit for Ellen because she's a qualified dependent. What amount of child tax credit is Courtney allowed to claim for Duran and Ellen after accounting for the credit phase out? Well, $2,500 because her income is below the $200,000. What if her AGI is $230,000? Okay, now we got to start phasing out how much she can actually take as a child tax credit. So we would take the amount her AGI is above $200,000, $30,000, divided by 1,000. So her AGI is above the phase out by $1,000 30 times. That's basically what we're saying. Well, what's the significance of that? Well, it's each occurrence or each time your income is above $100,000, you lose $50 of your credit. So 30 times 50, $1,500. So of the $2,500 she could have taken, she has to reduce that $1,500. She will only have a $1,000 child tax credit. That's a non-refundable credit for the most part. Sometimes it could be refundable. Meaning, let's say that Courtney's taxable income under this circumstance was $600. Or not her taxable income, her tax liability. Her tax liability is $600. Her child tax credit is $1,000. Well, generally she can only deduct $600 and she would lose the other $400. That's what a non-refundable tax credit does. The child and dependent care credit is different. This is for care. This is also a non-refundable credit. And it's the people who are eligible to take this are people who have children under the age of 13 that they have to pay child care for their children. It could be, it's usually a percentage of 2 or more qualifying persons. The percentage qualifying in expenditures, the maximum amount is $3,000 for one qualifying person, $6,000. Who's a qualifying person? Dependent under the age of 13 at the end of the year, or if they're disabled. Now, your AGI will determine what percentage you qualify for. These are listed at the top of page 8-26. Okay. Before we go into that, I wish I had an example in here for us, but we're going to do one. Page 8-26. Suppose this year, Courtney paid a neighbor $3,200 to care for her 10-year-old son, Darren, so Courtney could work. And that's the key. You have to be paying it so that you work or go to school. It's not a credit you can take if you're just, oh, I'm a stay-at-home mom and I need to go and, just get the kids out of my hair for a couple hours, 3 days a week. No, that doesn't qualify. You're paying these care costs so that you can work or go to school. Would Courtney be allowed to claim the child independent care credit for the expenditures? Yes. He's under 13 and it's for her to work. What amount can she claim? Well, for one child, the maximum you can claim is the lesser of the actual amount, your earned income, or $3,000. And that's what that table is showing there. Dependent care was 32. The limit on qualifying expenditures for one is 3,000, and her actual compensation is 1,600. So the expenditures are the lowest, 3,000. How much can she claim? Well, it depends. Where's her AGI at? Her AGI is obviously above 43,000. If you look in that table above our example, the most she can take is 20%. So a $600 child care credit. If Courtney's AGI were only 31,500, what would her child and dependent care credit be? Well, you would look at actual, the lowest of actual versus the limit because of the number of children, which is 3,000 for one, 6,000 for more than one, or earned income. So the lowest is still 3,000, but now the percentage can be taken would be 26% because her AGI is between 31,000 and 33,000. So 780. So the lower the AGI, the higher the percentage you can take of those three amounts. That's how the child and dependent care credit works. What about education credits? Well, there's two major ones, the American Opportunity Credit and, give me 1 second. And I will get right back to you. I have to answer something. And then there's the Lifetime Learning Credit. Now, the American Opportunity Credit is available for the first 4 years only of post-secondary education. So if you're an eternal freshman, you've been a freshman for 10 years, it's only the first 4 years of your freshman year. After that, you're not eligible. It's for eligible expenses and institutions only. So tuition, fees, books, at post-secondary education institutions. We're not talking about before college here. They are a per student credit. They're available to the taxpayer. That's one student. Spouse is another student. And each dependent is considered a student. So if you have 3 kids all in their first 3 years of college, you may have 3 American Opportunity credits. Any amounts paid by the dependent is treated as paid by the taxpayer because it is the taxpayer who can claim the dependent that takes the credit. What's eligible? 100% of the first $2,000 paid out of pocket, including student loans, any amounts received that would have to be paid back. That's how you could look at it. That you use to pay for tuition, books, fees, and then 25% of the next $2,000. So you may have a credit per student, depending that they meet these requirements, of $2,500. This is a tax credit. It phases out based on AGI. So once your AGI reaches a certain level, taxpayer, you need to reduce the credit. And the phase out begins at $80,000 for a non-married individual, non-married filing joint, and completely phases out at $90,000. For a married filing joint, it's at income AGI levels of $160,000 to $180,000. Some of the American Opportunity Credit may be allowed as a refundable credit, up to 40% of it. So if you look on page 8-27, because I'm not going to trust this PowerPoint to have an example. Let's take a look. Courtney paid $2,000 of tuition, $300 for books for Ellen to attend the University of Missouri, Kansas City during the summer following the end of her first year. What is the maximum American Opportunity Credit before phase out Courtney may claim for these expenses? Tuition and books are both eligible, so $2,075. Or I'm sorry, $2,300 is the total amount. The first $2,000 is 100% eligible. The next $500 she paid would only be 25% eligible. So that's where the 75 comes in. How much is she allowed to claim on her 2018 tax return? None. Courtney's AGI is way above $90,000, so she cannot claim any of the American Opportunity Credit. It's really there for lower to low-mid taxpayers who are paying out of pocket for college, in an effort for them to get some of their money back. If you take a look on page 828 before I go to the next slide, how much AOC would Courtney have been allowed to claim on her 2018 tax return if she were married and filing a joint tax return with her husband, and their AGI is $162,000? Well, now their AGI is between the phase out. It's above 160 but below 180. So of the $2,075, we would take how much is the AGI above the lower end of the phase out. So it's $2,000 above it. 2,000 divided by the phase out range of 20,000, 10%. So 10% of the 2,075 would not be allowed, or 208. So there would still be an American Opportunity Credit of $1,867. The final credit is the Lifetime Learning Credit. Oh, back up. The American Opportunity Credit, you are not eligible for it if you are a convicted drug felon, by the way. Okay, I just want to make that clear. The Lifetime Learning Credit, though, is for everybody else who doesn't qualify for that American Opportunity Credit. And you can be in post-secondary education for professional or graduate school, and it also includes continuing education. So if you're just paying for a seminar here or there, you don't have to be in a program like to get your master's degree or anything like that, a full-time student, or there's no qualifications on it for that. It is a nice credit. Married filing joint taxpayer is one taxpayer, and it is applied per taxpayer, meaning if you have 3 kids who are eligible, their expenses like tuition are eligible not for the American Opportunity Credit but for the Lifetime Learning Credit, and you're still claiming them as dependents. Plus you have some of your own education expenses that fall under this category. You have to add up everybody's expenses. So it's an overall. And only the first 10,000 of those out-of-pocket amounts would be eligible. Further, 20% of them would be the max. And of course, there's a phase out. It phases out, and this is very low. Non-married, 57 of 67,000. Married filing joint, your AGI is between 114 and 134. Okay, so it is a very low phase out. I know I've never been able to actually take it, but it's nice if you can. Take a look at the examples on the bottom of page 828 and top of 829. Here's another one. Courtney paid $2,000, there it is, of tuition. Of course, they always make a liar out of me. And $300 for books. What is the maximum credit? We calculated this already. If she's at an AGI of 162 and she's married, there's the calculation we went through. All right. But take a look at the Lifetime Learning Credit. It's there to catch you if you weren't able to take the American Opportunity Credit, which is nice. Next, now we get into some refundable credits, and this is the most abused credit in our tax system. It's called the Earned Income Credit. It's actually a negative income tax. It is available for people who will get a refund of it even if they have a zero tax liability. If their taxable income is zero, they may still get a tax refund without having paid any taxes in. You have to have earned income to be eligible for this. You have to be at least 25 but less than 65. So only people in those age ranges qualify, and you cannot be a dependent of another. Now it says see Exhibit A10, and that's on page 8-30, because there are tables we use to calculate this, and they change each year. And there it is. So if you are a married filing joint, and they have it between married filing joint and everybody else, those are our two tables. So this is the table for married filing joint people, though. You have 0 children. The maximum earned income credit you can get is $6,780. So just think, you have 0 tax liability. You could get a refund of $6,780. Actually, no, I read that wrong. The maximum earned income eligible, sorry. Now multiply that by 7.65%. Actually, your maximum is 519. All right. As a married filing joint, once your income is at $14,170, we start phasing out that $519. How much? 7.65%, the amount it is over $14,170. And it's, okay, AGI or earned income, whichever is greater. And then it completely phases out at $20,954. As you add children, those income levels go higher. There's your everybody else. Same type of table setup. So let's take a look at an example on page 8-30 to see how this works. Courtney's earned income for the year is $160,800, and her AGI is $187,000. Darren and Ellen both qualify as qualifying children, and that's one of the key. You got to make sure that they're a qualifying child in order to say you have children for the earned income credit. What amount of credit can they get? Well, that's obvious. It's 0. Okay, so if you're married filing joint and you have 2 children, you completely phase out when your AGI or earned income, whichever is greater, is at $51,492. But now let's change this up. What if Courtney's only source of income for the year, oh, I'm sorry, it wasn't even married filing joint. She's head of household, right? Yes, she is head of household, so that's why she didn't qualify. It's even lower for her, $45,802. Assume Courtney's only source of income, though, was for the year was $30,000 in salary. Assume her AGI for the year was also $30,000. Okay. Now let's take a look. We're going to look at all taxpayers except married taxpayers filing joint table. 2 children. Qualifying children are 2. We're going to use that row. First of all, her maximum earned income that's eligible is $14,290. Her credit then is 40% of that, or $57,16. Now, is her AGI or earned income, whichever is greater, which they're both the same, is $30,000. It's above the $18,660. So how much is it above the $30,000, or how much is the $30,000 above $18,616? $11,340. 21.06% of the $11,340 is the phase out, which is $2,388. So of the $57,16 she first was eligible for, we reduce it by that phase out of $2,388 because her income is above where the earned income tax credit starts phasing out. Her earned income credit will be $33.28. That's how you use these tables. Remember, this is a refundable credit. If you paid no money in, have no tax liability, and qualify like Courtney here, you would get a tax refund of $33.28. Not bad. The next 2 slides deal with the business credits. We said there's certain business credits out there that businesses may be eligible for, people who work in foreign countries may be eligible for. You could take a look at them. There's a great summary of all the tax credits on page 8-33. Now, when you are taking credits, non-refundable personal credits get taken first, and whatever's not used is lost unless there's a refundable portion of them. Business credits are then taken. Any amounts that are not allowed because they are above your tax liability would be carry back or carry over. You could actually use them in the future or use them from prior years. Refundable personal credits are taken last and they're fully refunded. That's how tax credits work. The final part of our chapter deals with what happens if you pay your taxes late or file them late. Here's the key. You must pay your taxes as you earn the money. So that's why our employers are required by law to withhold our taxes and remit them to the state as we're making the money, or the federal government. But even if you don't work at a job, you are required to pay in taxes related to the income you earn throughout the year on certain dates. April 15th is one of them. So you should estimate your tax based on the income you have as of April 15th and figure out how much your taxes would be and remit some of that money, at least a quarter of it. You should then adjust it and do the same computation for June 15th. Send another quarter, September 15th and January 15th. So you're expected to pay a quarter of your taxes basically at each of those times, even if you're self-employed. If you don't pay enough in, you will be penalized. There's a safe harbor requirement, and it says this: if you don't want to be penalized, pay 90% of your current year's tax liability. If you pay at least 90% in during the year, you won't be penalized, or 100% of last year's. Okay, so if you pay in 100% of last year's or 90% of this year's, you'll be safe. But if you don't, you're going to be penalized for underpaying your taxes. Your underpayment penalties are applied on a quarterly basis, so they look at each quarter. How much should you have paid in? And then they'll calculate the penalty to see how much you underpaid each quarter. And they will also charge interest on that. So it's just showing you how they go about the calculation. You must file. If your gross income is above standard deduction, that personal exemption amount does not matter. There's no such thing. They forgot to take it out of the slide. So if your gross income is above your standard deduction, you must file. Your due date of your tax return, we've talked about this, is the 15th day of the fourth month following your tax year end, which is April 15th, and you can extend it up to 6 months. But you cannot extend the due date for paying taxes. What does this mean? All your taxes, or the majority, a great chunk of them, must be paid by April 15th, or else you'll be penalized. If you file late, you will be assessed 5% of your tax owed per month, up to 25% if it's not from fraud. If it's from fraud, you've got a lot more penalties. There's no penalty if no tax is due. So that's filing your tax return late. Late payment penalty. So if you don't pay an entire amount owed by the due date of the return, 5% of the amount due, up to 25% maximum. If it's not a fraudulent reason, it's higher if it's from fraud. So that's why we say even if you're in a legal business, file your tax return, report the income, pay the taxes. The combined late filing and late payment penalties may not exceed a maximum amount for either one. So there's some great examples and some reading there. I suggest you go through it and post any kind of questions you may have or email them to me. Okay, so that concludes Chapter 8's discussion on additional taxes and tax credits. Oh, I guess I have one more slide to go. Assume Courtney filed her tax return on April 10th included a check with a return for $4,072. The $4,072 consisted of her underpaid tax liability of $4,000 and her $72 underpayment penalty. If Courtney had waited until May 1st to file her return and pay her taxes, what late filing and late payment penalty would she owe? Well, of the $4,000 late payment, 5% times 1 month. And it would be combined with the late filing fee as well. Okay, so now I'm done. That was the example actually at the end of Chapter 8. So if you have any questions, like I said, please post them. Thanks.